Hello, traders. It's Matt. It is July 25th. I just wanted to take you through credit spreads tonight. So this will be one for the options guys. So let's get right into it. We've had some good credit spreads lately. One of the reasons we're using such short-term credit spreads, and I'm talking like intra-week, so starting Monday, Tuesday, ending on Friday, is because they're very good with high implied volatility. When you don't know what the market's going to do in general in the near term, and we'll get to that in a little bit. That has to do with market valuation metrics, and um, and if a stock, especially these days, is having very nice price action, it's having a good move, but you don't, we just don't know what's going to happen in 2-3 weeks out, which is at least what you need when you're buying calls and puts. So I like credit spreads just because that extrinsic value, so everything above where the current strike, where the strike price is of your options and the current stock price, the difference between those two, if you're in the money, is the intrinsic value. But obviously, when implied volatility goes way up, the extra over that is the extrinsic value, and it includes a lot of time decay or theta, and it includes a lot of premium for implied volatility. So I'd rather be a net seller of that than have to buy it. And you buy it in debit spreads, and credit spreads, you sell it. So I'm looking forward to those days counting off and me just collecting that theta in implied volatility decay. Let's get into it. So obviously, what is a credit spread? There are two: bear call spread and bull put spread. The first word in these is obviously indicative of what the position is going for. So if you're bearish on a stock, instead of buying puts or buying a debit spread, which would be a bear put spread, a bear call spread is essentially the same thing, just has different dynamics to it. Like I mentioned, when implied volatility is very high, I don't want to be buying that. I want to be selling it, because in a debit spread, you're selling the out of the money options, and in the money options have more extrinsic value. Their implied volatility is usually a little higher, depending on how far out you go with the out of the monies. So this is why I like credit spreads lately. And the other one is a bullish put spread. So instead of buying calls or a bull call spread or just lone calls, what you do is you sell a higher price put, higher strike price put, and the lower strike price you buy. So you're going to have a net credit on both of these. And the charts show you, obviously, which way you want the stock price to go. So a couple of weeks ago, during that week, we've been doing a lot of intra-week credit spreads, and it's worked out very well for us. But this is just one example. This is an example where the stock price keeps moving, right? So it doesn't look like a big move, but that's a $55 move from the pink lines during the week. So a lot of people say, well, gosh, you did a credit spread, you missed out. Because usually when you do a credit spread, it does have a max gain, and you cap yourself there. So anything else above that is going to be lost gains. Well, not necessarily. Yes, buying a call at the time we made the spread would have made more money. But a call is not hedged. A spread is. When we did our first position, this was our first position, 237.50, 242.50. So it's a $5 spread. This was the credit we got. and that was this day right here. So 1-to-1 reward to risk. And then Tuesday we obviously did nothing, but Wednesday and Thursday and Friday, you can see it just kept going. And the histogram, very strong, showing buyer conviction. Sellers are napping. The relative strength index continues on its up and up. And, for the first time in a while, we saw the volume rate of change turn green and actually start to spike up. So, or at least move up, as it's been, just flat recently. So what you can do as you see the stock price moving up, is just you keep your long puts, so the 237.50, which you paid $4.35 for, you keep those. But the short puts, I call it, you just keep rolling it up. So on Wednesday, which is this day, we did two of those. So we rolled it up to the 245s, which means we bought back the 242.50s, and we sold the 245s. That gave us 93 cents in a credit. And then from there, we did it again from 245 to 247.50, and we got another $1.05. So now we're into this, the total of these. Then Thursday, same thing happens. It goes up, and I think it ends that day at just shy, I think it's like $1 shy of 260. So by the end of the day, we have verticalized to the 260 puts. But first we went to the 250s, trying to stay conservative here. Bought back the 247.50s. We sold the 250s for $1.20. And it's almost a 1-to-1 there. I mean, it's a 250 spread, so, we get almost just under half of that. But then we do, later in the day, we roll the 250s to 260s because we see this thing just isn't messing around. It's got, there's almost 3 times the average volume there. Average volume's in the white line. Histogram, very strong. Relative strength, very strong. And volume rate of change, very strong. And the candles are just bullish. Look at these. They're all just, they start where they ended the previous day, and then they close at or near the high for the day. Love those types of candles. Those are great candles. So Thursday, another strong day. And then Friday, obviously, just gaps up again. Very strong volume. Let's see. I guess this was the volume for Friday. So very strong volume, 3 times volume, average volume, takes it up. And this is why we will roll these up. If you can, I could have hung back at the 260s, but at almost noon, all I had left to accrue was 6 cents per spread, or 6 cents per short 260 strike price put. Well, that's not really thrilling, right? I don't want to wait 2 more hours just to get 6 cents. So, and plus the stock price has moved $25 since then. So why not roll it up? Try to gain some more alpha. So that's what we do. We buy back the 260s for 6 cents, and we sell the 280s for $1.86. And so what you have at the end of it, and it ended up at 285. So for the week. So what happens is all of the bars were met for max gain. So you add up all of these credits, and you get 1178. And So that's how much you made on this credit spread by rolling up during the week. You would have made 250 had you just left it alone, but we were a little bit active and rolled it up as we saw the price. The price action was very positive. Everything was indicating that this thing was just rallying, and as you've seen, it's continued to rally. We had a great week last week as well. Did the same thing, kept rolling it up. I think we ended up rolling it up to 345s. So we ended up in max gain again. So, but this comes to 1178. So you put in 250. It's actually a credit, so you receive 250. But the way it's calculated in the journals, the Trader Sync journal, is you spent 250, and then you end up making almost 350% on that trade per spread. So 1178, which is of course 1178. Now, reasons to use credit spreads, as I mentioned, uncertainty about the market in the very near term. Everyone I talk to, and I talk to people that are pretty in the know, or at least savvy when it comes to the market. We all agree that the market's frothy here. I mean, hitting new highs every other day is just not a lasting equation, right? It can't last forever. But none of us knows when that's going to end. So we have to follow the price action, right? But I don't want to commit to a longer duration options play like buying calls. I mentioned that, yeah, you get all the upside, but you get all the downside too. And I don't know where the market's going to be in a month. I really don't, because of these types of things. This is the Buffett indicator. I don't really go by that. It just measures annualized GDP versus the aggregate U.S. market value. But this one, everyone goes by the PE ratio. And you can see that, this was the tech bubble. This was the PE back in, the Great Recession. And this is what it is now as of July 23rd, last Friday. 94% above the average. And that puts it well above 2 standard deviations out from the mean. This is crazy especially when you look at, let me pull up another, I'm just going to hurry and pull up another set of images that kind of hits this home too. Where are you? There it is. So I pulled this up a few weeks ago. So we've got S&P price to sales or PE ratio. Look at the 3 times, the 3 peaks. This was the tech bubble. This was the Great Recession. And that's where we were at the time. I think that's end of March. Now, price to sales ratio, there's an argument to be made that the price to sales ratio should be higher now because we are more tech reliant than ever. So a technology company doesn't have as much overhead, relies on technology. Their margins are usually higher. So the price to sales ratio should be justifiably higher. And there's an argument to be made for that. But this much higher? I don't know. So I'm going to just, I put that in there just to show you, but so the top one and the bottom one are what scare me. We've got earnings growth rate. This is for, I believe, trailing 12 months. So back in, let's see, where's that? So 2010, earnings growth was great, but we had this peak here. Let's see, 08, here we go. Now it starts to plummet. And that's what gets us into that recession. Well, we're plummeting now, but we still have this peak going on. And remember, this is back in March. As of last Friday, we just hit a new high. It's got to be up around 50. So this is suddenly getting, I mean, just the chart shows you that these were very significant events in the market. And every one of these, well, these two ended up in massive corrections. Well, why wouldn't this one also? It's just not a lasting equation that we keep hitting new highs, especially with negative earnings growth. That makes no sense. So, right now the market's drinking the Kool-Aid and we're traders. We go along with market sentiment. We're not trying to time the market. Yes, I think a correction's coming, but I don't know when. So I'm taking these very short plays and just following the chart, doing what the chart's telling me. But hedging by taking short duration plays like 4-day credit spreads. I do it every week. And if I want to roll them up, if the price keeps running and running, then I'll keep rolling it up. But if suddenly the market turns and turns hard, well, then I've hedged and I have a spread on, and I do have that maximum loss calculated. It's definitive. So, conclusion, great for times of high volatility or when a stock price appears to be making a significant move now. So you want to get in on it now. Because of that volatility that's happening right now, you're going to get a great credit spread. You're going to get a great credit and just watch that extrinsic value just decay and wither away. And or when the certainty of the market in general is in question. So I'm doing shorter plays. I don't know when the market is going to roll over. It could be not for a while. I mean, I thought it would have happened by now, honestly. So, but when you see these bullish trends in these charts, and you just can't deny what we're seeing. I mean, you can't deny this strength. I mean, there's strength in every indicator. I can't see anything. Up here, it gets kind of that's a big range for a day. $50 in the day. But in the end, did it stop it? No. Friday, it ended up closing at the high. I mean, this thing just has strength. So sometimes you gotta plug your nose and buy bullish strategies when you see very, very bullish charts. And again, the NASDAQ, new high, very bullish action here. It came down drop below the 20 for a minute, and then just another V formation there. And S&P, same thing, tested the 50, strong bounce off of it. The Dow actually went below and closed below the 50, but the next day erased that. So and so it's clear that people still want to be buying stocks. And part of it is, what are their alternatives? A lot of people don't have access to hedge funds or these, private equity funds or, some of these other alternative investments that, say a family office would find, or, more sophisticated money. The crowd doesn't know where else to go. I mean, bond yields are, I'm not even going to say it. CDs, what are you going to do? Market money or money market accounts, where you can make, low single digits per annum. That's just not exciting at all. So that's one of the problems, but it's not a lasting equation. You cannot keep buying the market up because the valuations are getting ridiculous. So anyway, that's the credit spread. This is how we're using it right now, and it's working out very well for us. All right, guys, trade well, my friends. We'll talk to you soon. Let me know if you have any questions.